Welcome, FinTech Talkers, to another edition of the FinTech Talk Show. I'm your host, Patty. My guest today is Beatrice Lion, fondly known as Bea, CEO and general partner at True Global Ventures, in short, TGV. Bea is from Singapore, but spends a lot of time in the Bay Area, where she is today, in San Francisco. TGV is a global multi-stage, multi-instrument, high-touch with an embedded operating platform VC. That's a lot. We'll unpack a lot of that today. We'll be talking about TGV's and Beatrice's journey and where they go from here. TGV has invested in global market leaders like the Sandbox, Animoca Brands, Forge Global, and more recently, Ledger. TGV is now deploying later stage companies into later stage companies, Series B and beyond, through its opportunity fund. Beatrice is a board member and board observer on a number of TGV's portfolio company and has been with the company since 2017. And in my books, a candidate for Forbes 30 under 30. And if you get a chance, we'll talk about that too. She started really early with investing. So if you're interested in the future of venture capital, trends in AI, we're going to talk about that, in blockchain, the emergence or resurgence of blockchain, and the future of work, and insights from a seasoned venture capitalist, then listen on. Welcome to the FinTech Talk Show, Beatrice.
Thank you, Patty. Thank you for having me. Those are a lot of high praises that I hope to live up to, but I'm excited.
No, you're all that, and we'll unpack that for our audience. But before we get into all that and TGV and how it's different and the multi-stage, multi-instrument and some announcements that you want to share with us, can you tell our audience a little bit about yourself, including your interest outside of venture capital, investing and guiding your portfolio companies?
Sure, definitely. I think one of the things that I would mention is that if I'm not working with our portfolio companies or TGV, then you'll probably find me trying to hike some mountains. I like to live on the edge, literally. So I will be up in the parts of the Alps or some other parts of the mountains doing a Via Ferrata. And I feel like that's really nice because it helps me to get some focus, kind of takes my mind away and rethink, reorganize. So that's something that I really like to do. Of course, that's also a lot of traveling involved, but I really like being in the mountains. That helps me to balance a little bit. So that's a little bit outside of VC, but I would say to almost 99% of the time, you would see me behind the computer screen talking to myself.
No, so that's very interesting. And if I may, what some of the recent or the tallest mountains you've hiked, and are these day hikes or do you do backpacking as well?
No, I do like a hut to hut hiking. So actually I just came back from Norway. The Norwegian fjords are beautiful.
Yeah.
I did the Trotunga, so you have like a 2 day, 1 night. You can do the Via Ferrata up there. I also was in the Lofoten Islands. So that's a very beautiful place in the north. They have the midnight sun in the summer. Summer is always great because you don't have to, rush out and be like, I need to get back, I need to get down the mountain. You can literally be at midnight and be like, okay, 2 more hours to a pseudo sunset. So that's a really nice time and really takes your mind away. And sometimes it also helps you to feel like things that you are so caught up in is just this very small part of the world. And that helps me to feel that because you feel really small in nature and that gives you a little bit of perspective. The Bay Area is great as well because you have all the redwoods, especially with this kind of like gentle giants, if I have to put it that way. Kind of feels like time passes so slowly in the redwoods, so it helps you to calm down a little bit because we are always so addicted to being productive and so addicted to being efficient. So I definitely love all the redwood hikes here in the Bay Area as well. Great
Yeah,
thing to do in the weekends.
that's great. And you should check out Mount Whitney. It's more in the Central Valley. It's the tallest in the contiguous United States.
Mm,
And you can drive up, I think it's a 20K total, but you can start, I think, at 7 or 8. It's a popular hike. And,
definitely would plan
and
that.
yeah, yeah. And of course, Shasta, although people don't go up that, people like Mount Eddy and the ones in Portland and Seattle. But they're all 14ers as they call them
Mm,
here. But that's fascinating. I'd love to get some tips from you on that. Um,
100%.
Getting on to TGV and venture capital, Um, Venture capital, which was more of a Silicon Valley phenomenon, is now global, and you know it better than anybody else. Um, but the operating model also has evolved. And you have been at it for a decade with exposure in Asia, Europe, and in the US, including Silicon Valley and New York. Can you share, before we kind of get into the TGV model, can you share, step back and share some of the challenges that you think are evolving the operating model?
Yeah, I think in terms of the operational, the way we have run it is that we didn't want to go through a very hierarchical structure. So in our VC model, it's very partners heavy. And that being said, you kind of do what a full stack GP would do. You would do the fundraising part. That's the beginning of the cycle. That's usually one of the hardest part, actually, because you're basing out of track record, you're selling a dream. And then once you get the funds, you deploy. And deploying, arguably, it's a whole marathon because obviously when you put in that money, you think about already what kind of multiples you are expecting, how you're going to exit eventually, or what are the options that are available. And between, for us at least, where we see that we are able to add the most value is immediately the 12 to 18 months immediately after we invest. So that's where we kind of like pump in all the fuel. And the reason why is because that's where you can really make the difference for these startups because we're investing in the earlier stages as well. And that's when they really need you. We have focused a lot of that. And after this, 12 to 18 months, then the biggest value add we could provide to them is to find them a lead investor for the next round. So you're passing the baton to the kind of later stage investor. And in our case now, we also have growth stage funds. But that would be typically the kind of value creation journey. And then you get, a larger valuation, the company matures, hopefully, is growing at a good traction as well. And then after that, you would have the exit part. But from the fund life cycle, if you think about it, the exit stage is typically also the hardest part, the one that has a lot of pressure, whether you want to take some money off the table whenever there's liquidity, because you have LPs that you have to respond to. A large part of that is driven by the whole thesis for us that we put a lot of our own money in the funds. So we're completely aligned in terms of thesis to our LPs in terms of our economics as well. We make money not on management fees, but actually on the performance, on the carry. And that I would say operationally, the entire VC structure is going to change. I think the average GP commit in the US is easily like 1%. And for us, it's between 25 to 35% in our current funds in terms of GP commit. And the reason why I think that that is something that has to change in the VC world is that if you're not putting in your money where your mouth is, it's very difficult to have the same kind of conviction when you're exiting or when you're even deploying the cash in the beginning with this portfolio companies. And, in some cases, I came across GP that says that, sometimes we even take management fees and roll it into the GP commit because to them, that is a good commitment. But for me, it's like when you take money from your own pocket and you actually put that to deploy together with the LPs, and in some cases, even more than the LPs, that for me is the alignment of interest. And so for me, I think that operationally is an alignment of incentive that the VC space is looking at more, it's transitioning more into, but still very early stages. Our LPs, though, really like that because they see that, we make money and they make money. So that's basically the key part, I would say, that we have structured maybe a little bit differently, and maybe we work a little bit differently from the regular VC.
Yeah, no, that's huge. Yeah, 25 to 30% GP commits and across and very partner heavy. That's putting your money where your mouth is and incentivizing, meaning high carry, they say, is a good incentive for GP. But what more than having a 25 to 35%? That's like the best incentive. No, that's awesome. Definitely a very different model than Valley. As you said, it's kind of in the 1 to 2% usually on GP commits. Um, but in terms of the VC model, I know the original Silicon Valley was very defined. There were a lot of exceptions. You did not have, or at least in the US, you did not have to follow a lot of SEC rules. You did not have to have an RIA license. And it was very tailored. You could only invest in a very specific asset class. But I
Mhm.
there is a trend to broaden that and talk to that a little bit, right? Maybe
Mm-hmm.
like you kind of talked about raising money as one step and then deploying capital. So
Mm-hmm.
LPs and managing that, it goes to that hard, right? So when LPs are looking at your fund, they're looking at, okay, what obviously your track record, but what can you do and what is the risk and what are your options and how can you diversify and things like that. So talk to that like from a TGV perspective, but also
Mm-hmm.
industry trends. Is that kind of broadening? Are the lines getting blurred that VCs are kind of becoming bigger in some ways?
Yeah, so I mean, we've seen the embryo of that with Andreessen and Sequoia starting with getting their RIA, registered investment advisory portion, and then you have Lightspeed, and most recently also General Catalyst that has done that as well. Our license here in Singapore, the one that we just got now newly, it's basically a comparable to the RIA license here in Singapore, in the US. And what it allows us to do is that there were a couple of constraints, and it's the same here in the US. You have this venture exemptions. So one of the constraints was that we could invest maximum 20% of our funds into secondaries or companies that are older than 10 years. And as you can imagine, with private companies staying private longer and longer, also, even if they do not, the thing is that when startups are in a climate where maybe the macro environment is not so favorable to raise a higher next valuation, they would much rather hold it out. If they have a good enough treasury, they wouldn't raise anything at all. And it is our thesis not to invest in a company only once. We like to invest double down 2 times, even up to 5 times in a rare cases, even across funds in rare cases in our companies. So that's basically where we come to a point that in the first time we invest into the company, say it's at the beginning of the investment period, if that same company that we want to double down in doesn't raise before the end of our investment period, which is 3+1 years, so 4 years typically, and sometimes in the US it's typically 5 years, but in our fund structure it's 3+1, then what happens is that if the company raises in the next round after our investment period, we get diluted and we cannot protect our position. So typically at this point in time, what we can do is that we can come in with secondaries, often at a good discount as well, because your early angel investors would look for liquidity. They have made good enough capital, and they would definitely be open to take some money off the table as well at that stage. So then there's an opportunity where we can help the founders and entrepreneurs. They don't get anything out of this because in the secondary, there's no new capital injection to the company, but it does help them with cleaning up their cap table. It does help them to become a little bit more, I would say, maturing in their kind of cap table as well. So that's where we would like to do more in the secondary space. And what we have seen actually in our last early stage fund is that when we were at the end of the investment period, we had roughly around 8.3 million remaining to deploy out of the reserves that we have already deployed in. And then we came to a stage that we had already maximized our 20% rule, and we couldn't do any more secondaries. And none of our portfolio companies were raising because they had a good enough treasury. They didn't need to raise. The climate wasn't that great for raising, so there was no need to kind of prove that market dominance with raising another round either. So what we were looking for at that point in time was more secondaries. And so that's when we started to apply for this bigger license. So it was actually a very small reason, if I have to put it away, out of the entire basket of products that we could offer with the equivalent comparable of the US RIA. And in Singapore, we call it the Licensed Fund Management Company. It's part of the Capital Market Service License, and it allows you to invest in pretty much any of the asset classes as long as your LP base are accredited investors. And geographically, it's also indifferent. You can invest anywhere in any part of the world. So that was kind of when we started. This process took us 20 months. So it was very intense. And that's not a license that normally VCs pursue. It is a license that hedge funds, private equity, they pursue because they need that to offer products that they are actually servicing. But in the VC space, you're probably better off in terms of compliance costs, regulatory burden to start with a light license, or in the US case, a venture exemption. So that's kind of where we started. And as we start to see all these constraints coming up to affect us commercially, we thought that it is worth to bite the bullet to invest in this process. And that's exactly where we did. And that's where we kind of grew up ourselves as well. So the institutionalization that you're talking about is a lot also on the way we have operated our company. We have to take our compliance in-house. We basically hired a head of compliance who was formerly with the regulators in Singapore. And so he had the experience to support us instead of doing that outsourced function. We took in a little bit also in-house on the operational side. Even on the fund administrator side, we've taken part of that also in-house. Obviously still with the support of fund administration. So some of that maturing processes does come with costs as well as a compliance burden. But the result of that is that when this license came to us August 13, we were super excited because from a timing point of view, we realized that there was so much opportunities that we could leverage on beyond just secondaries. Of course, the immediate effect was that we could do more secondaries. So we're actually now in the midst of a process acquiring a larger block of secondaries. I'm not going to name the name, but basically we initially thought we only could do 1.9 million in buying secondaries there. And that was like all we had left of the 20% target or constraint. And we increased that immediately once we got the license. We increased that from 1.9 to 14 million. So we're doing a 14 million block, and that does materially impact our entry valuation. So of course, that's a positive thing as well commercially for the fund returns, because obviously price does matter. So that's one thing that we have already immediately commercialized. And with this secondaries, we see that branching out not just into where we are as a venture, early stage investing, or even our kind of growth opportunity. We see that also even continuing beyond the growth part. So as a continuation fund is something that we could set up because there's no constraint investing in companies or maximum 20% invested in companies that are less than 10 years. And in a continuation fund, we will be able to follow on our portfolio companies from the early stage where we invested into to the growth stage to even pre-IPO rounds. So that's one piece that we have also been pretty excited to set up. So that could be, TGV7, for example. And back on even TGV6, so we have our next early stage fund, which is what we call TGV6. It's basically investing into applications in AI, including the intersection of AI and blockchain in the early stage. And prior to that, we have been investing into AI since 2013, into blockchain since 2016, but we have not invested into crypto directly. So we were not allowed to do that because it's a gray area within our previous license, the venture capital fund manager license, what type of asset it would constitute, would it be a qualifying or non-qualifying asset? And so, but now what we can do is that we can even inject cash into crypto directly. I'm not saying that we're going to set up a whole, crypto fund immediately, but what we can do immediately is that in Fund 6, we can incorporate that in some of the companies that are in the intersection between AI and blockchain. Should they launch their tokens, we no longer have to do it in a token warrant model or, be on that limitation. We could even invest directly into the crypto part. We could buy more crypto. We could hold it to an opportune time to exit it. So previously what we did was that anytime there was crypto that hit our balance sheet, we would liquidate it and distribute the cash to our LPs. But now we could find a better and opportune time to do that. Some of it could also be in the form of an exit. We could sell a blockchain company through taking it in crypto. And with that crypto, we could find an opportunity time to sell. And that does affect returns. It does affect multiple on the exits as well. And subsequently, of course, we are also interested in launching a crypto fund. But I'm just saying, like today, what we can do already, we can do that incorporate into our Fund 6. So that I would say are some of the short-term benefits. But obviously, we're looking also beyond that. So another area that we're looking at, but more from the medium to long-term area, would be, I would say, the fund of funds strategy. So we've always seen how a lot of emerging fund managers are struggling ourselves. When we started raising in 2017, 2018, we were struggling to raise our first external money fund. So even if we had capital before, so True Global Ventures was initiated with Dusan Stojanovic. So he started a solo GP. We had investment vehicles. Those were not regulated funds. The first time we raised external money was when we got the venture capital fund manager license. This was in 2018. And actually that just a segue into that, it is a full circle moment for me because I was actually involved in getting the VCFM license when I first joined True Global Ventures. And this was in end of 2018 that we finally got it. So getting the LFMC now, really feeling that, kind of growing up process after 7 years is a huge milestone personally for me as well, and of course for True Global Ventures. But back to the point. So basically, we saw a lot of struggle. We had, 2.5 years it took us to raise our first fund, so first external money fund. So we know the entire process. And when we look at fund of fund strategy, we look at it upon that it's almost like, how are we going to add value to this emerging fund managers? So we do want to focus on emerging fund managers in a fund of fund strategy, because we see it's like almost to draw a parallel, like how a business angel would invest a lot of time and effort and, not just capital into a startup. And then they would open up their Rolodex, open up their networks, their connections to help these startups. It's the same as how we can be a very active fund of fund investor, where we could help emerging fund managers, support them in the process, whether is it getting in, their license, or, upgrading their license, or moving to the next fund, raising fund two, arguably sometimes harder to raise than fund one. And so that's where we see also in the medium to kind of medium term, where we can look at, not immediately, we're talking about like 3-4 years kind of roughly stage, because that's not raised yet. And the other opportunity that we have been looking a little bit at more as well is into crossover funds, looking at investing into public markets as well. So prior to this license, all we could do is obviously private markets. We could not invest into public companies from our funds. One example I would like to bring, and then you will see why I'm bringing this up, because it inspires why we look at the crossover fund part, is Forge Global. So this is a company that we backed called ShareSpose. This is in 2011, and they combine number one and number two global market leaders in secondary market trading. So Forge and ShareSpose combined in roughly, I think, 2019. They listed on New York Stock Exchange in 2022, and then they became a public company. But they were very much affected with the macroeconomic environment, with the public markets pricing kind of collapsing. So at some point, they were valued at their cash positions. That is incredibly sad position to be in a public company, because then at some point you're better off staying private. And with that, we could invest directly ourselves as individuals into the stock of Forge, for example, because we know from before that it is a very cyclical business. When the IPO window is closed, that's when there's less transactions, the bid and ask spread is very far, and you don't have that much secondaries being matched. But when the IPO window reverts back and it's open again, then you see all the transactions. So we could buy on our own, and we made money on the stock price, but we couldn't have shared it with our LPs. We couldn't have shared the economics of LPs, because we're not allowed to invest into public market companies in our existing funds. So, and obviously there was no conflict of interest if we were to invest into it directly ourselves. So that was kind of where we also saw that in the companies we invested into, just because we have been backing them for a while, we know the business model, there is an advantage above, regular public market equity investors who have been in the space, and they can do a lot of the analysis much better than us, because we have understood the business when they were private. So that's a little bit where we see an angle on the crossover funds that we have an edge over as well. So those, I would say, for the fund of funds and the crossover funds investing to public markets, that asset class, I would say, is more for a medium term for us. So something that we're looking at in 3-4 years time.
That's awesome. No, you shared a lot, so a lot to unpack there, Beatrice. So first, maybe I should congratulate you. So the license is a huge accomplishment. You said it took 20 months to get, and this is from MAS, the regulator. It's kind of a uniform regulator, unlike in the US where you have a lot of regulators in Singapore, but it allows you to deploy globally, and you are head to head with some of the leading Silicon Valley firms, like I think Sequoia. You kind of mentioned that it's the equivalent of the RIA kind of equivalents in the US under the SEC. Sequoia and some others like General Catalyst and I think Andreessen all have had that or pursued that in the recent past. So TGV is right up there with them in terms of this institutionalizing phenomenon that we're observing in venture capital. So congratulations being to TGV and Beatrice, being this is huge. And you talked about laid out some of the advantages with your options to invest in secondaries, crypto, the crossover funds into public markets, and using a fund of fund model, so to speak. So that gives you a lot of opportunity. So how does that translate into kind of you have a lot of options, obviously. So it does mean that you now have a lot of LP access suddenly, a lot of institutional money,
Mhm.
even sovereign funds are now going to come to you for your funds, or translate that as to what happens.
Yeah. So I'm not going to glorify fundraising. It's an incredibly hard process. Just because we have a bigger license, we have more products that are available, doesn't mean that money comes easy. Definitely not. So that's why when I said like medium term is because we do anticipate that we have distribution events, sizable ones that would help us to continue on with our next fund because our existing LP base will get distributions, and that's the best time to actually pitch them for the next fund or a next thesis that we have. So in terms of our LP base, we primarily have a large family office network in terms of our LP base. That's our primary LP base. So we're not that much into institutional investors. We have actually more a family office investor base. They have been a steady existing LP base that have supported us before Fund 4, Fund 5, Fund 6, and we hope, in the future as well. And getting into the products that we talked about, like in family offices investing into fund of funds, into public markets or crossover funds, there's definitely some allocation there. But what we are also looking at is increasing and expanding the team. So we want to work with, fund managers who maybe they have also done more in the kind of later stage pre-IPO companies. Maybe they have done even SPVs to finance into like OpenAI or SpaceX, some of those managers or some of those, if I have to put it that way, interested to join us. We are happy to look at, working together. In fact, we actually, after announcing the license, we got a couple of inbounds of, already existing fund of fund investors who actually like to be together, work together under an umbrella. And they see that if they're raising a fund of the first time, they have a platform together with us. They can capitalize on the brand. They can also get exposure to our LPs. They can get exposure to our deal flow and some of the managers that we co-invest with as well. So that's definitely something that has helped us to expand or look for talent in terms of recruitment. But it would be too much for me to say that, I'm going to run every single fund, or, my existing partnership is going to run every single fund. So definitely we're looking at expanding recruitment there. One thing that I mentioned is that, yes, we're very excited about all these new products and all this new expansion into other asset classes, but our core is definitely venture, early stage investing. So we will keep this 100 to 200 million size funds that we always have with 4, 5, and 6, and so on. Whether that number really matters or not in running order, but this is bread and butter for us. We do still focus on investing into early stage, and that's what funnels also into the continuation funds. It funnels also into the crossover funds, eventually in terms of deal flow and the portfolio company. That being said, we're not, above and beyond and thinking that we want to immediately jump into like getting a $1 billion fund. And the reason why is more a principal thesis reason rather than, an ego reason. It's really because we feel that we are able to make sure that our performance is delivered on a 100 to 200 million size fund as opposed to a $1 billion fund. It's very difficult to deploy a $1 billion fund and expect the same kind of returns, making sure that you're in the top 3 percentile of the venture capital cohort. It's very difficult with a very large fund because you just have to find way more companies at the same time within the investment period to deliver the same amount of returns. So that's not the business that we are playing in. We are not playing the management fee with a large AUM business. We are playing in the performance business, and we make money when our LPs make money, to my point earlier. So that's why 100, 200 million size fund is still our bread and butter. And so that's where our existing team is going to focus on. And then with the new team, like I talked about, we are looking at recruitment. We are teaming up with or looking at teaming up with other fund managers. And that's a little bit more on the kind of platform play that we have something to offer. We're still going to focus a lot on our roots, but then we would have complementary new team members, new blood as well, to actually support us on the other types of fund. For example, when I talk about setting up a crypto fund, we will start with one fund manager as a new team member who have maybe had experience running very liquid crypto funds, and they can start with maybe 20, 25 million type of size funds to start off with as a parallel structure together with our venture funds. So that's kind of how we're looking at expanding, definitely with the team, definitely with fund managers who have done something before in the new asset classes that we want to do as well, and focus on our core bread and butter in terms of resources, existing resources.
Yeah. So that's fascinating. And I have a lot of listeners in the manager community, venture capitalists, and some fund of fund folks too. So let's kind of double click maybe on the profile that you're interested in recruitment because they might be people who are listening to this.
Mm-hmm.
So
Mm-hmm.
so maybe what kind, like the geography, what specific expertise maybe, and how should they get in touch with TGV?
Yeah, so I would say like geographically wise, we are still focused on our 8 cities. So Bay Area, New York in the US, London, Stockholm, Paris in Europe, Dubai in the Middle East, and Singapore and Hong Kong are basically our core cities. We tried expanding further and to more cities before, but we realized what really worked for us is to have very deep networks in these 8 cities as opposed to spread ourselves too thin. So these are the geographical reasons that are regions that are of interest for us. And we've been spending a lot of time in the US, especially the Bay Area, because we have a bias towards investing into US AI companies. I would say, especially for that thesis in the blockchain space, is pretty spread out. So we don't, a lot of them are running on decentralized teams. So we don't really have a specific favorite, if I have to put it away. But on the US side, definitely we see a lot more capital pouring into building up the AI infrastructure. So technology advantage for sure, but also that the clients are situated out of the US. And we've even seen that in our own companies, like the products that are being launched. Maybe it's offered at a price that is almost 1/3 in Southeast Asia compared to what you can get for it to a client in the US, for example. So definitely there's also an advantage of client in the market, just the size of the market as well. But being such a global structure and having such a thesis of investing globally, there is always that ability to be able to bridge investments. So for example, some of these US entrepreneurs, they are dreaming like, I don't only want to target a 300 million, whatever population in the US. I want to target the 5 billion population globally. I want to be in core markets. And that's where we can help them to expand outside the US. And the reverse is true as well. So if there are companies that we are backing with the ambition of getting into the US, that's when we can help them to get into the US as well. So that's important for us in terms of a value add to the companies that we back. So we are that bridge that helps them to connect amongst these 8 cities. And that's why building our network that is deep within these 8 cities is important for us. And in terms of fund managers, so if you have something within this 8 cities, especially like I mentioned in the US, we love to talk to you and look at what you have. Probably if you're a super experienced fund manager, that is something that we could even work together with because you have your LP base. It will be complementary with our LP base, and we can basically cross-sell, different asset classes, and that I think has a lot of synergy. And we're not there to, micromanage and force you to fit into our box. We're there to find that, can we grow in a way that is synergistic for both of us in terms of fund manager. So that's one piece. And then if you're a first-time fund manager that you want to enter into like a fund of fund space, for example, and you don't want to build out your own platform from scratch, or even if you could, you just think from a time point of view, it's more efficient for you to start with a platform that already exists, then that's something that, what we could offer as well to come under our umbrella. And, we can definitely hope we can get a 1 + 1 = 3. So that's kind of the two, I would say, boats that I would say we have been getting, but we've been getting also some inbounds. And so we're always exploring, definitely open to new ideas. We're not shut off on anything. And this we only managed to do because we got this bigger license. We can expand into different asset class. We're less limited to only sticking within the venture thesis.
Great, great. And that's great. It's not only for early or first-time managers, but established managers. You can provide different services
Absolutely, you can run independently as well, and just
right.
we can find synergies within our LP base, for example.
Right. And then, so lot of potential synergy. So the folks who are listening again, just to kind of run over, it's TGV is, I think, more global than or more has a wider footprint than maybe many of the big Silicon Valley firms. So definitely New York and San Francisco Bay Area, Silicon Valley, and then Paris, London, and Stockholm, was it in Europe?
Yes. and then
Okay.
Singapore, Hong Kong,
And,
and Dubai. So
and
yeah, I
Singapore,
mean,
Hong
just
Kong.
one phenomenon that we have seen is that definitely VCs are choosing to be more local than global. I mean, we've seen Sequoia split up, and then you have PickXV in Southeast Asia. They rebranded. GGV has split up. They have Granite Asia as well. So you see them running independently in terms of different geographies. And for us, we are sticking with what we believe is actually more beneficial, which is having that presence across the 8 cities. And we do not want to, split up that, because we think that that is actually our value add. That's actually what differentiates us as a VC and as a fund manager compared to others. I'm not saying that, Sequoia or GGV is doing something wrong. Of course, they are like huge. But I'm just saying that, this is how we feel that we can do a very high touch, high return approach on venture investing. And, Andreessen has also been doing a lot of that. They have a huge BD team to support, and we don't have the resources to hire like a 80 people BD team to support our portfolio company. But even Andreessen has put back their employees in the UK and focus a lot on the US. So I think where we can stick out a little bit more is basically that advantage that we still believe in that cross-border thesis. We still believe in bridging companies from maybe Europe or Asia getting into the US, and then also from the US coming out and expanding beyond just the US. So that's where we think it's actually our competitive advantage as well.
Gotcha. So, folks, we're talking with Beatrice Lion. She's CEO and general partner at TGV, and we're talking about this phenomenon that's happening in venture capital around institutionalizing of venture capital, where firms are kind of becoming financial services provider broadly. And as Beatrice talked about the different asset classes, a recent license they got from MAS, the regulator in Singapore, and how that changes their investment thesis, how they can grow. We talked about recruitment in all these global cities, 8 cities around. So we covered the institutionalizing part, and the new license is a big change, and we talked about how that gives you a lot of optionality to grow. The other trend, I think, and Beatrice, you can tell me if you see this in venture capital, both in Valley firms and or across in the globe, is that VCs now need to be global. So
Mm.
big Valley firms have set up offices in Singapore, in Europe, and India, even other parts of the world. Um, so that seems to be important, but TGV started as a global firm.
Mhm.
So how are you capitalizing on that, and how is that making it a big differentiator for you, for your LPs and your portfolio companies?
Yeah, so I do think that there's two schools of thought, and we belong to the one that we really want to be global. We want to maintain that network across the 8 cities that we have a strong presence in. The other school of thought, which is not negative, is just pulling back and going to local, looking at the companies that they have within. I don't want to say like the old saying of like investing only where you have a church view of. If you're standing on a 7-story building, you can see that company, and that's where you invest. And that's your geographical boundaries. But for us, we've always looked at that as very limiting. In fact, the first deal that we did was actually in the inception of when we talked about Dushan incepting the entire vehicle with True Global Ventures. He invested into ShareSpools out of Europe. So that's already a first, cross-border transaction, and that was happening in 2011. One of the things that I would say for global funds is that you always have to prove why you're better than a local fund when you're targeting a company in that specific jurisdiction. So take an example, like when we are getting into a cap table of a US AI companies, there's tons of US capital in basically VC space, a lot of managers, VCs that are basically investing into the US space. And why would you not want to have a US cap table? So that's basically an added barrier that you would have to prove. Like, why are you better than another shop that I can get access to? We're in the same time zone, and I want someone like that to be on my board, to be a director on my board. So that's another piece that a very global VC would face. And for us, at least, where we have been able to prove ourselves has always been the value add that we're able to bring to our portfolio companies. So the proof is in the pudding. If you don't get that kind of board seat, you don't get that kind of governance, that means that you're not doing enough, because then they don't want to give it to you. So almost always, actually now always, whenever we invest, we reverse pitch our entrepreneurs the value add that we can bring to them. Is it just, clients? It could be replicating that. It could be finding them distribution channels. It could be getting them next lead investor in the equity round. It could be getting them debt capital providers to finance the acquisitions. It could be getting them acquisition targets, or even, potential buyers of the company. Not every company goes towards the IPO route. So those value add that we provide with the examples, again, call up our previous entrepreneurs, how we've supported them. That is what gives us the credibility as a global VC, because you always remember that at the end of the day, these startups actually do prefer, apart from just a branding point of view, also local VCs to back them. So that's another piece I would just mention for the global VCs. That I would say has played to our advantage, because we have seen that with the value add we are able to bring in as a global VC with the network, there's always an added part that we can bring in that a local VC cannot do. So I'm not saying that you should only raise from global VCs. Definitely, it's a complementary cap table. So you should have both. It should be a good, diverse cap table. And in terms of the local angle, so I've seen a lot of fund managers. We have invested a lot of fund managers that they only invest in the US, for example. They only invest in this geographical region, and that works well for them as well, because they can meet their portfolio companies often and less travel. So that's definitely useful. So I wouldn't say that there is a negative point there. But when your company asks you for help anywhere outside, that's when, you basically your hands are tied. You wouldn't have the same kind of network. You would not have the same kind of depth. And the good thing about being global that I should mention as well is that, for example, regulation takes different shapes and form in different jurisdictions at different pace. So what we benefited a lot from investing into blockchain and AI is that a lot of it is very much linked to regulatory clarity, and there's different pace and different speed of regulatory clarity. Then we come to the point where there is a lot of political tension between different geographies, and indirectly we benefit from that as well, because it's a natural diversification amongst our LP base, amongst our portfolio companies base. So we've always been a very strong advocate that diversification and that diversity brings performance, brings ARR. So, a completely US cap table versus a cap table where you have US companies, you have US investors, sorry, or global investors complementing that. I would much rather pick a cap table with, global investors involved as well. That being said, of course, you should have your good base of US investors that we've seen a lot of companies doing well in that as well. But that's just our difference in thesis.
Yeah, no, the axis is huge. And especially you alluded to it, the changing geopolitics now, and we don't know where it's going to settle. Obviously, a lot of things are in flux, but it's always a good hedging strategy to have that kind of mix in the cap table. So TGV is naturally global. I mean, they're evolving their institutional form with the new Singapore MAS license for capital market services. Um, there is often the third thing that's talked about. It's kind of more the platform that the VC provides, right? So it's just not capital that makes a startup success, right? There's a lot of other things, right? So typically what I have seen in the Valley is obviously marketing support, setting the trends, kind of creating narratives to bring the industry along, kind of creating that, priming the market for the portfolio companies, so to speak. So there's obviously a lot of narrative and marketing building. And then some VCs get into recruitment. Obviously, they have such a large network, so place across. And off late, one large firm is actually doing DC lobbying. So lobbying and things like that for especially some reg tech and fintech and that kind of industries. Maybe it's important even for AI now, I guess.
Mhm.
So if I club all that into what I call the kind of the platform for VC. I think you do a lot of that too. So can you speak to that a little bit of what you offer to your portfolio companies?
Yeah, absolutely. So I think with a lot of VCs say they add value to the portfolio companies, but what they really want to see is like, what have you done before? And that's where we will share, the experiences of how we have brought in strong lead investors to our portfolio companies after our stage. So whenever we come into a company, we lead, we price, we take a board seat, and basically from a governance point of view, we are supporting the portfolio company all the way before we pass the baton. And when we pass the baton, we want to make sure that the next lead investor is someone that, you know, the portfolio company is going to benefit from. And that's where we actually do a lot of like introductions, open a lot of doors. And for a portfolio company, that's incredibly valuable because as an entrepreneur, sure, maybe you invest a lot in serial entrepreneurs. So definitely they've tested themselves before. They've definitely raised funds before, but we have raised funds together with a lot of our portfolio companies. So definitely that breadth and that spread is much more than I would say just the entrepreneur himself doing that. So that's definitely one thing that we can support our portfolio companies in. And basically opening up distribution channels, or even if they have a client profile, we can replicate that client profile with our database of about 16,000 contacts across our 8 cities. So that's where we can basically help to accelerate the growth of a company. It really depends on the stage. At the later stage, maybe they're not looking for clients on that way. They're looking for distribution channels. They're looking for capital partners in the complementary way. So debt capital financing, we actually have a good network around debt capital providers that are in a very complementary business with us because it's non-dilutive for us from that point of view. Sure, you have some warrants, but it's still non-dilutive, and they can finance the kind of acquisitions that a lot of roll-up strategy has, especially with the AI model and the applications that we're investing into. A lot of play also comes into a roll-up model. So that's also something that we can provide support with in a very complementary way with our network of debt capital providers that gets comfort that we are on their cap table of these existing investors, existing cap tables. So that I would say is definitely a huge benefit. To the lobbying part, just to speak on that point, there's definitely a lot of clout around investors, especially the large names. You have your Andreessen, and I think one thing is that for us, TGV, we're not that involved in the lobbying process, but definitely more within amongst our portfolio companies, definitely thought leaders for consultation papers that are being recommended through our portfolio companies, how they would like to progress within a certain industry, within the kind of clarity on the regulations, whether we're talking about Genius Act or the clarity bill that's going to come out. And so that I would say it's more on our portfolio company level, less on TGV level. So I don't want to take any credit for that. But yeah, to your point, there is definitely clout that the investors can bring on a political level to influence that. And we do see that also happening with the new administration. There was a huge relief rally for the blockchain industry. We definitely benefited from that. I'm not going to lie. And obviously, there's a lot of restrictions with regulatory when you're talking about innovation. And so with this relief rally that we're seeing right now, definitely was a result of years of lobbying.
Yeah. No, totally. And I can vouch for the network that Beatrice talked about, right? So I have attended several over the last few years now, TGV lunches, especially in the Bay Area. But I'm also familiar with some of the other locales like New York, having introduced some folks. They're awesome, meaning, and the portfolio companies really benefit from the network of corporates, other investors, other industry leaders, and they're very serious about it. And I think Beatrice talked about it. They have a large Rolodex of network across those geographies that they operate. And it's a huge value in go-to-market and lead generation for the startups and so forth. So I think the platform that you built organically, if I can say that, is hugely valuable for the portfolio companies.
Exactly. I mean, we started running this, if you're talking about events that we were running, we started running the events since 2015, end of 2015, I would say. And this is we've done 71 events now. So these
Wow.
are more like thought leadership events, putting our portfolio companies with thought leaders in the panel. And then sometimes there's something commercial to be done as well in this panel. So there's basically a curated way of not, hot pitching, but actually finding synergies while discussing a topic, while looking at a vision of where this place or this technology is going towards. And then we also do our business reviews in a way that it's not just reporting from our portfolio companies, but we also bring a network of local industry leaders through these lunches and dinners where we interact with our portfolio companies, and basically we could do business together. So that's kind of how we have supported, or it's a platform to actually add value. So that's how we industrialize the way we add value to our portfolio companies as well.
Yeah. So if you're a portfolio company, or if you're a startup looking for a good investment partner, don't just look at the capital. Meaning, yeah, capital and the valuation you get are important, but look at what the VC brings. They become your distribution. Your lead investor becomes your distribution or primary distribution. So, and TGV, I can vouch, is a solid, especially if you have global aspirations. It's a solid. So look into them if you're looking to raise funds. And now you have the breadth, right? With the new license, you can do seed investments. You have the opportunity fund that you're doing Series B plus, and but you can do secondaries and whatnot, right? You can get involved in different ways. So definitely look at TGV as an option if you're looking. So Beatrice, we talked a lot about venture capital and I loved it. This is not something I've had recently, kind of how the model, the operating model is changing, and how you are kind of almost running head to head with some of the top tier Silicon Valley firms. But one of the things I like to talk to venture capitalists about is also current trends.
Mhm.
And obviously the AI obviously is still a flavor, and you briefly mentioned with the regulatory regime changing with Trump, there has been a resurgence in crypto and blockchain and DeFi. And there might be some other trends too. Obviously, space and quantum and those things are there, maybe not immediate. AI and crypto may be the two big ones. Do you want to share kind of your insights around where do you think that's going and how that's influencing your investment thesis?
Yeah, I want to start with the blockchain space because, I think we're seeing Gemini did their S1, Figure did their S1. So it's been a very heated up space, actually, when you're looking at the IPO window for blockchain companies. And earlier this year, we had Circle with a very successful IPO. I think, signaling the opening of the IPO window, not just for the blockchain space, but also a broader opening up of the IPO window. So for us, I guess in the blockchain space, there's three mega trends that we are seeing right now that are really heated up space, of which we do also participate in through our portfolio companies. So one of which is in the stablecoin space. And what we have seen, especially with the recent, I guess you call it like a US, what do you call it, crypto regulation week, when they were releasing all of this new regulations,
Genius
definitely.
Act, yeah, yeah.
Yeah, with the Genius Act and with the clarity that US is not going to launch their own CBDC, that's definitely something that's bringing a lot of clout towards the stable coins space. We are participating in that indirectly with Animoca Brands, one of our portfolio company. They announced a joint venture with Standard Chartered, the British Bank, a lot of presence in Asia as well, to do together with Hong Kong Telecom to do a first Hong Kong dollar-backed stablecoin. And that is something that we're definitely excited to see, because we will be seeing people with, good partners having the flows, winning in the stablecoin space, and then probably crumbs below, but that's our thesis, and we'll see how it fans out. Also with the stablecoin piece, my own personal interest around that actually comes in between the intersection of AI and blockchain,
Hmm.
where stablecoins can be used as a payment settlement between AI agents. So at some point, when AI agents communicate with each other, they're gonna have to deal with settling payments. And you're not gonna expect like an AI agent to set up a bank account. I'm not sure bank accounts are ready to, or banks are ready to onboard an AI agent. But what you can do is that you can have AI agents settling with stablecoins. So that's another use case. But that's just a private, a personal interest to look into that space.
Interesting.
That's
Yeah.
the first mega trend that I would say. The second mega trend that we're definitely seeing and feeling is the digital asset treasury strategy.
Mhm.
Started with the Bitcoin strategy. You see it with Michael Saylor. Then it went a little bit more geographically with the FX thought around it. So you have, for example, MetaPlanet, and then you have the blockchain group in Europe, where if you would like to have exposure to MicroStrategy, you don't have to take, if you're a European investor, you don't have to take that risk of US dollar and euros. You can just invest in the blockchain group doing the similar strategy. So we see a little bit of that with the Bitcoin piece. And then now from Bitcoin transitioning into Ethereum, into Solana, treasury strategies. So we see that also moving steadily. That's another very heated space, I would say, in the mega trend of blockchain. And then the third piece, and that is basically tokenization of private company stock. So that's where we really believe, where the traditional finance, or TradFi as you call it, would meet the Web3 finance, or DeFi as you call it, space. And that's what we call real world asset tokenization. So we've seen that quite a bit, even with Robinhood, who is doing that also on the private company stock. Actually, most recently, our Forge that I talked about earlier, they announced during their Q2 earnings call that they are also looking at this tokenization space. And I do think that they're very well poised to be in this space, given that they have facilitated already a lot of secondaries in private markets. So they have the inventory, they know how to do the transfer, they work with the issuers. The other piece about this entire space is that we see a lot of SPVs being set up to trade OpenAI shares, for example, or SpaceX shares. And most recently, there was an article that has OpenAI and Anthropic kind of coming back and saying, we need to stop all these SPVs because we don't know who the end UBOs are. So we're not even able to report it to the authorities. And where you have a tokenization piece, you want to make sure you do it right from the beginning. And that's where I was mentioning that I think Forge is well poised to do so, because they control how the transfer process has always been. So if they were to tokenize it, it's a simple, easier way of settling the transactions. And if they were to be able to do it in 24/7 in real-time settlements, then the tokenization piece would really work for them as a private company stock. And that creates a lot of access and creates liquidity as well. Arguably, in the perfect world, if you can tokenize private company stocks so efficiently, there's not that big of a difference between a tokenized private company stock and a public market stock, because you can create that same kind of liquidity, you can create that same kind of access. So if you do it well. So I mean, that those are three of the mega trends that we see in blockchain today that are basically being in a very heated space that I just like to comment about.
That's great. Any take on AI? And
That,
maybe
that,
I'll qualify. There was a recent comment, I think, on Twitter or X, that a lot of the projects are still, or AI initiatives are still projects. They're not businesses, or startups are still projects, not businesses. So any comment on that? Is AI still a hype, or where are we on the hype cycle?
Mhm. We're definitely still investing a lot in the AI application layer. In fact, our Fund 6, we're actively deploying into AI companies in the application layer that are between 1 to 5 million of annual recurring revenue. So we don't invest pre-revenues, but we're interested in looking at that space and exchanging on deal flow there. One thing that we're noticing is that definitely the client side, they're looking at a consolidation. They're going to be evaluating the return on investing in these AI tools and application. Is it worth spending all that capital into investing into such AI tools for the productivity gains that they're getting out of it? So that's kind of where we see, because everyone has been experimenting a lot, buying different products, trying different products. And at some point, they're going to have to consolidate and say, this is the one that sticks. This is something that we're going to do internally. We're not going to buy. And this is, something that we're basically going to buy, and only this product and not the other competitors. So I think at some point, we will come to a stage where they need to show that the benefit of productivity outweighs the cost that you're paying for the SaaS, or the cost that you're paying for the AI application or the AI tool. So that's something that I would say maybe it's typically mistaken as looking at AI startups as still projects and not businesses, because we have not gone through that phase where the clients are now starting to test, and the demand is quite a lot to manage, because the expectations of these clients are getting higher and higher. You're expecting the AI to be able to do all of this, huge amount of prompt that you feed into them. They're able to deliver everything, and people get smarter and smarter in the prompts. It gets more complex. So with that obsession around productivity, I would say that AI tools are definitely there to still stay, but there will be that kind of funneling where really the ones that have actual value and actual productivity gains, not priced at an expense that is beyond the productivity gains, would stay. And that's why you really have to select the category leaders and the best of each vertical or the application, ideally with a niche around proprietary data that they have above anyone else. And of course, there's always that threat that if a large language model were able to build the next version that is going to outperform your small language model or your vertical application, then you better be way more integrated than these large language models. You better have some proprietary data that they cannot get access to. You better have something that you can offer to these corporates or clients that are stickier than what a large language model can offer. So I think that's the kind of moat that we are always looking out for when we are deploying into the AI space. That being said, for me, I don't think it's a project. I think it's a business, because I think these tools have provided a lot of convenience in the world today, and nobody wants to go back. And nobody wants to kind of have to draft their own response to argue themselves out of a fine. I always say that because I actually use ChatGPT a lot for that. And yeah, I mean, what I'm trying to say is that all the menial tasks and the mundane pieces, nobody wants to go back to draft them themselves. So that being said, I was at a conference a while ago, South by Southwest, it's very popular. And I heard Vinod Khosla made a comment where, AI will underperform people's expectations in the next 3 years and outperform the next 10 years. And I think that is exactly that case because of the build-up of, how much we expect AI to perform right now. Maybe we're going to get disappointed, and then we're going to underestimate how much they are going to help us in the next 10 years. But it's definitely here to stay.
That's great. That's a great quote. And 3 years underperform, but overperform or just beat our expectations in 10 years. So to be seen. But Beatrice, this we can continue the trends because I think that needs its own episode. So we'll have to have you back. We've been talking for a while, but just stepping back on all the things we talked about, right? So the evolving operating model of venture capital, how TGV has evolved over the years with your new license in Singapore for like the capital markets access, kind of the equivalent of the RIA. So you've kind of institutionalized or you've kind of progressed on that layer. You were always global. You still are global. You have these 8 cities access across 3 continents. And then you provide an amazing platform for your portfolio companies with access to potential clients and network and ecosystem across your footprint. So what, Beatrice, what I'd say is you built a full stack venture capital model, a global reach, now regulatory licenses for flexible investing that gives you a lot of optionality for your LPs, from fund of funds to secondaries to access to public markets and even crypto if you need. You have the optionality. You may not do everything, but now you can operate like that. And then a real operating platform, like we mentioned, for your portfolio companies. So you are what I call, and I use this in the introduction, a global, a multi-stage, a multi-instrument, high touch with an embedded operating platform VC. So where do you go from here? How will you compound that advantage in the next cycle?
I think honestly, buddy, we just need to deliver. I mean, those are a lot of like high praises that we'll like to live up to. But the core of the business is to deliver returns, deliver performance, and along the way, being a technophile, I really hope to back some of the most exciting companies in this space. Even if they're not exciting, definitely an instrumental piece of technology that we're going to use in our daily lives. That in itself is a huge fulfillment for me. But as a fund and as a fund manager as a whole, I would say that we just need to continue delivering, not be, overly overwhelmed by all these new multi instruments or different new asset classes we can tap into, but focus on the core where that's going to deliver our good returns, get us good deal flow, continue being proprietary, having proprietary data, and not reinvent too much of the base, the bread and butter, but we can be definitely exploratory in terms of the new asset classes with that focus.
Well said. Well said. It's all about execution, right? And that's well said. So in closing, Beatrice, We talked about who you're looking for, kind of expanding your team, emerging managers, established managers to come into your kind of ecosystem. Who else are you looking to connect? Obviously, maybe startups, and kind of list out maybe what kind of startups you're looking for
Mm-hmm.
augmenting your deal flow. And how can people get in touch with you, like social media, if you want to give out handles and
Mm-hmm.
things like that. So go.
Yep. So definitely, like Paddy, you mentioned the fund manager, we talked about the profile. In terms of startup, we're actively deploying out of an early stage fund right now. So definitely, if you're an AI company based out of the US, you're doing in the AI application layer, you have some embryo of revenue traction. It doesn't have to be 1 to 5 million AR, which is our sweet spot, but you're just coming to one. That's when we start looking at you, we start tracking you. We love to get to know you early as well. In the application layer, we especially like different areas, what we call future work, especially on the back office side, whether is it the boring stuff like accounting, bookkeeping, legal AI, KYC, compliance AI, customer support AI. We like looking at all of that, especially if you think you have an edge. On the front office side, anything marketing and sales, productivity gains on the front line, mid office, cybersecurity, coding AI or no code AI. That's going to be something that we're also excited to look at. Other areas that we're looking at also is AI and education. That's also another opportunistic vertical that we look at. Energy optimization. We haven't done anything there, but we do think it's a very interesting antithesis that maybe not a lot of people like to do in this current administration, but that means that there's also an opportunity there. And exceptionally, I would say our favorite and somewhere where we have good expertise in is the intersection between AI and blockchain. And a lot of people ask, what is that? But it could be, like I mentioned, using stable coins to help settle with AI agents. That's just one example, but it is a space where two technologies that we know very well interact with. So we're definitely excited about this, some of those verticals. And if you want to reach out to me, feel free to reach out to me on LinkedIn. It's you can type my name, Beatrice Lion, Lion. It would probably appear up. And through Global Ventures, feel free to reach out to either of that on LinkedIn. We are very active on LinkedIn all the time, or our website.
Great. Thank you, Beatrice. Do come back on the FinTech Talk Show, but thank you for being on the FinTech Talk Show today.
Thank you for having me.